15th, you could review that material. Okay. Now, what we looked at in Chapter 18 is recognizing revenue, and we said that you typically recognize revenue at the point of sale. That's when you have a reasonable and uniform test of recognizing revenue. Delivery takes place, title passes, simple enough. However, we do have the ability to recognize revenue before delivery takes place, and this is something that we'll use when you have the right to bill. If you have the right to bill, you now have what is known as income that is realizable, and it can be recognized, and we use the percentage of completion method. I'm going to go over some disclosures very quickly with you, and then we'll move on. But if you don't use percentage of completion, you'd have to wait until contract is completed and use completed contract accounting. Then we said that you could also recognize revenue after delivery takes place. That's the installment basis. It's a cash basis, essentially. Cash basis is used because there's a high default risk, a high probability of default, and therefore the earnings cycle is not completed. In order to have the earnings cycle completed, what do you need? You have to have no uncertainties as to future cost and cash realizability. Here, there's a lot of uncertainty as to realization in cash, and therefore you wait until cash is collected in order to recognize revenue. We have the installment method or cost recovery. I'll show you both methods in just a bit. But before we do that, let's conclude. I'm not going to go to the questions here, but on Module 18.2, I believe it's page 12, I just want to go through a couple of disclosures. And these disclosures were modified from an actual company. And you can see that they do have their contracts in progress or their net contracts in progress. This, in fact, if you look at this one line here, this is from the percentage of completion basis. It is a current asset. And why is it current? If a construction project takes 5 years, why is that current? Yeah, normal operating cycle, right. So if this is within the normal operating cycle of the company, if this is their normal business, and it takes them years, 3 years, 4 years to complete each project, then in fact it's still a current asset. Okay, still a current asset. Now, they're in a net asset position. What does that mean? CIP exceeds billings, if you remember. Right? So you have to remember, if you're in a net asset position here, these are unbilled receivables. Remember the term unbilled receivables? So overall, this company's in a net asset position, meaning that CIP exceeds the billings on CIP. Now, in the footnotes, it might tell us a few more things. First of all, the revenue recognition definition is pretty standard. That, incidentally, comes exactly from the SEC requirements, that there has to be a pervasive agreement. Sales price is fixed or determinable. There has to be performance, delivery, and of course collection is reasonably assured. From the second paragraph, you see the highlighted area, and in the highlighted area it says that revenue generated, this by the way was a telecommunications company, so they're using the percentage of completion method for their long-term contracts, and their degree toward completion is measured by units of delivery. That's an output measure. Now remember, we said you could measure the degree of completion by inputs or output. We're using an input measure which is cost to cost basis. And I'll show you another company in a moment where that is in fact the case. Now, the second highlighted area here, which I wanted you to really focus on, is that revenues and costs are revised periodically. Now you remember, hopefully from the example, I know it was a long class, I don't even remember it myself, but we looked at a company that used percentage of completion. In the second year, the percentage completed went from 40 to 38%. And therefore, they had to recognize a loss of $410,000. That loss is not a total contract loss. It is simply a loss on a given year because of a revision. Those revisions are recognized as prospective changes. You don't go back and change prior years. And this last comment is important, and that is that you will recognize a loss immediately regardless of the method that you use. So for example, the example I gave you in the case of the parking deck, this was not a total contract loss. This was a loss in 1 year. If there's a total contract loss, let's say, this is a 3-year contract. Let's say in the second year, there's a total loss on the contract. If you remember, the contract was a fixed fee, and the fee was fixed at $6 million. At the end of the second year, if you know you've already spent more than $6 million, you're going to lose money on the contract. If that's the case, you recognize the loss immediately, whether you use percentage of completion or completed contract. No matter what method you use, the loss is recognized immediately. So when there are losses on the contract, you're not going to wait until it's completed. The loss is recognized immediately. And we'll talk about multiple element arrangements or multiple deliverables. Now, in here, what I wanted to focus on was the changes in this account. Now, you notice that the account is going up, correct? But what's more important for an analyst, and the reason why we provide these disclosures, is take a look at CIP. CIP goes from 10 million down to 7. So I'm looking at, let's just round it up. So there's a credit in that account for 3 million. Why would you credit an account? Why would you credit CIP? What's that? Yeah, you could have had a contract could be completed. Or what else? Let me negotiate. What do we see in our example? In year 2, there was a loss, right? It was a change in estimate. So, can anyone tell me, is there enough evidence here to tell you what this was? Do you think this was a change in estimate, or were they completions? What else would I need to look at? What else? Well, let me help you with this. What's the journal entry you make when you have a completed contract? Yeah, you debit CIP, and what do you credit? You credit CIP, what do you debit? How do you close out the contract? What are we going to debit? No, you credit the... The billings. So we're going to look at billings on CIP. So the entry to close out a contract would be to debit billings and credit the CIP account. Did that happen here? Yep. If you look at the billings account, it also went from 10 down to 7. Roughly. So I would conclude that there's no change in estimate. And by the way, if there was a change in estimate, and if it was significant, they'd have to tell me. But this is what the footnote is designed to show an analyst, that the contracts are being completed, and that's what's causing the drop in those accounts. And they're dropping by the same amount, right? And this is a published statement. I just changed the name and the years, but I didn't change the numbers. So that tells you that you've got some completed contracts in there. Okay. All right. Let's go to the next one. This I didn't change the name because there's no numbers or anything in here. So in Raytheon, they use percentage of completion also, and they're using the cost-to-cost basis, which means that the degree completed is the ratio of cost incurred to date over the estimated total cost. And then they also tell you, the last highlight here, also tells you, since many of the contracts extend over a long period of time, revisions and funding estimates during the progress of the work have the effect of adjusting earnings applicable to the performance in prior periods in the current period. What does that mean? It means that you could have overstated income or understated income the year before, but you make up for it in the current year. It's a prospective change. You don't go back and readjust prior earnings. You would change in the year that the estimate changes, or you adjust in the year the estimate changes. So in our example, go back to look at our illustration from last week, and it was a case where we needed to debit or at least have a loss crediting CIP, and we had that loss flowing through. And of course, once again, when the current contract estimate anticipates a loss, that loss is recognized immediately in the current period. Recognized in the current period. Okay. Now, any questions on the first exception to recognizing revenue at the point of sale, which is the percentage of completion? And completed contract, of course. Okay, just want to make sure we cover those disclosures. Now, let's go to the last module, which, let me bring it all the way up for you, covers or our objectives would be to look at this last exception to revenue recognition, which is cash basis accounting. And we'll look at both installments and cost recovery. I'll also spend a few minutes on software, industry, revenue recognition, and then some disclosures. The proposed revenue recognition standard, I've got some information for you in the back of the module. I also have a recorded lecture that's in there as well. If you need to look at that going forward, it's there. Hopefully it doesn't, I don't think it's going to change that much, but we've already been picking up pieces of it as we've been going along. I'll show you a little more of that today. When you look at the need for a cash basis, once again, it's recognized after delivery. We can't recognize revenue at the point of sale because the revenue recognition concept is violated. Revenue recognition is violated because of uncertainty as to collection. And there is a high default risk on these installment sales. Now, of course, your first question should be, why would I sell to someone with a high default risk? Two reasons for it. One, it's the industry. You know, farming. I always use the example. John Deere makes tractors for farming. Where are they going to sell them? Got to sell them to farm cooperatives. And with economic difficulty, sometimes they don't get payment. Real estate. You have a limited market for commercial real estate, and maybe, you know, there is always a default risk there as well if the developer decides to walk out. So, yeah, you're still selling in a high default scenario, but what's the key? Repossession. You could repossess the equipment. The equipment has very high repossession value, and because of the repossession value, that is something that would lead you to continue to sell in this type of industry. Now, under the installment method, I'll get back to the cost recovery. Under the installment method, it's actually a very, very simple concept, and like a lot of accounting, it's tedious. And in this case, you have to keep track of lots of information. But when you look at the installment method, the concept is very simple. Let's say in 2014, you have sales of 1,000. These are installment sales, so let me make that clear. Make that 1,000, not 8,000. You have cost of goods sold of 6, and of course you got a gross profit of 400. And those are the percentages. Now, under this approach, you would recognize sales, cost of goods sold, you'd recognize operating expenses exactly the same way. But let's assume no cash is collected. No cash is collected in 2014. If no cash is collected in 2014, then all of this gross profit is deferred. It's not recognized. So until you collect, you don't recognize any profit until you collect. Now, every time you collect cash, you're going to recognize profit. Let's say you collect $100 in 2015. How much revenue are you going to recognize? 40% or $40. So basically, I'm going to recognize $40 of gross profit based on the amount I collect. But here's where the accounting nonsense comes in for you. You got to keep track of every sale, the year of the sale, and when you collect cash, you have to know what year the sale originated. So I need to know that this 100, although it's collected in 2015, it's collected on 2014 sales. And I have to know that this 40% is the 2014 gross profit percentage. So you have to match cash collected with the gross profit. That's where the tedious part of this comes in. It is a cash basis method, meaning that you have to recognize revenue only when cash is collected, and here the proportion of profit you recognize is equal to the gross profit margin. Now, I'm going to show you, if I can get this going again. I'm going to show you an example. Let me go through this with you. Okay. On the bottom of page 2, we have data, and I'm going to put this up on the screen too as well, for 3 years. We're only going to do accounting in 2011. I'm only going to do your accounting in 2011. But notice that in 2010, sales on installment sales are 500. The installment sales have a cost of goods sold of 3, and the gross profit is 200,000 with a 40% gross profit margin. In 2011, we now sell 600,000 with a cost at 410 with a 32% profit margin. And in 2012, 800,000 in sales, 440 is your COGS with a 360 gross profit. Now, of course, you realize that, for example, in 2010, 200 divided by 500, gross profit divided by sales is your profit margin. Now, when we look at this, and we're only going to focus on 2011. We know that in 2011, let me just highlight this for you again. We collected $180 from sales in 2010. And we also know that in 2011 we collected $200,000 from sales in 2011. Now, using the cash basis, I would recognize revenue, and I'm going to show you the entries in a minute, but I'm going to recognize revenue based on cash collected using the percentages for each year. So what's my gross profit percentage for 2010? What's my margin? It's 40%, right? So I'll recognize $72,000 in gross profit. And in 2011, I also collect from 2011 32% is my margin, so that I'm going to recognize a total of $136,000 in realized profit. Yep. It's 190 divided by 6? Oh. 136,000. Average, do you average it? Oh, no. Is your question, do I now come up with a new profit margin for? No. What's going to happen on the income statement is that sales are recognized in the same way they always were. Cost of goods sold are recognized the same way, but you defer a piece of the gross profit and only recognize a portion. So the profit margins that you see will not necessarily, maybe if you add everything together, depending on the disclosures, you get a different average margin when you read the statements themselves. Right, yeah, that could happen. We don't do that formally, but it could happen when you read the statements. Yeah. You have to keep, yeah, I mean, if there's a long-term contract, usually contracts have contract numbers. There's some identifier in the information system that would link that cash receipt to a particular contract, and you would know when that contract was originated, and you would know the margin on that contract. Now, for you, of course, you'd be told, as you are here. All right, now, let's go to the journal entries. The journal entries are actually pretty simple, except you have to remember, I guess, two kind of exceptions on the closing. So let's go to the entries. When you sell, we're only going to do 2011. So on the sale, you debit the installment sales receivable, and notice it has to be kept track by year. So you have a debit to installment sales receivable, and that's for the year 2011, and you credit installment sales for the total, which is $600. So you record your sales in the typical way. Cash receipts, however, again, getting back to the question I just had, you got a debit cash for $380, but the installment sales receivable, the credit has to be by individual receivable. Now, of course, on the balance sheet, we're going to get to an example, everything is grossed up, so you're not going to see the years, but that has to be done internally. So you can have a debit to cash at $380, you got a credit to installment receivables of $210, and 2011, $180 and $200 respectively. So notice you record sales like you did in accounting 1. Cost of goods sold, same thing you did in accounting 1. And collections, the same thing you did in accounting 1. So when you do your cost of goods sold, you debit COGS and credit inventory or purchases. Now, the differences are here, and this is where we got to pay some attention. The differences are in these 3 closing entries. The first is going to close installment sales and cost of installment sales to an account called deferred gross profit. The deferred gross profit is a liability. It is like unearned revenue. So we're going to see that on the balance sheet, we have our installment sales receivable, and we have our deferred gross profit. This is the asset account, that's the liability. Deferred gross profit is a liability account. Now, again, in this case, cost of goods sold, debit COGS debit the installment sales cost at 410, credit the inventory 410. Now for the closing. The first closing entry is going to close out revenues and cost of goods sold to deferred gross profit. You don't close that out to income summary. So this is going to be where we close out. So in this first entry, this is where we close out installment sales and cost of installment sales. Then the second thing we do is we recognize the gross profit. And we already know that we've got 72,000 coming in from 2010, 64,000 recognized from 2011, so it's 136,000. The entry debits the deferred gross profit and it credits the realized gross profit account. And I have T accounts that follow. Okay, you can take a look at those as you go through this on your own. And then, of course, you close out the 136 to retained earnings. So the only 2 accounts, and that's the third, the only 2 entries, I should say, that are different, or that the closing must first close sales and COGS to deferred gross profit, and then you have to recognize the amount realized. You recognize the amount realized only to the extent that cash has been collected, which we've already gone through. Right, so we already went through this with you, with the calculation. Right, so before we go any further, any questions on recognizing the deferred gross profit, then the portion realized based on cash collection, and then the closing to retained earnings? This is not, I'm sorry, I'm going to get over here. No, it's just a fan as I can't hear it. Yeah.
It's not a financial statement requirement. I mean, do we have to present those transactions in cash basis?
If you're in like real estate, if any of you do work in financial services and in a real estate unit of any public accounting firm, you'll find a lot of the clients will use the cash basis. They're using an installment method. I mean, it's a method that's used. Now on the financials, as I said, I'm not going to, you don't have to go through all this, but if you wanted to look at this is a deferred gross profit account. It picks up all the years. It also shows you an income statement. So what would happen is that you obviously would have to show 136 as realized in this year, and you'd have to make an adjustment for the deferred gross profit on the income statement. right? So if you took 136, I just want to see what this comes to. Oops. Yeah, so that would mean that, to answer your question before, if I took the, amount of the gross profit that actually this should be deferred gross profit, or realized gross profit, excuse me. That should be realized. The realized gross profit, that gives you a margin of about 22%. So the average gross profit margin here is about 22% on sales. Okay. Yeah, Sal. Yeah, I mean, again, we always work under the assumption that you're only doing this once a year and at year end, but this would be done quarterly or monthly. Probably internally, you would do this every day you collect cash. So for external reporting, for us, we're assuming you only do this at the end of the year. But no, you're right. This would be done every day. As soon as the cash comes in, you'd identify it by a certain receivable and then recognize it every day. Right, so are there any other questions on the approach? So this can be recognized. For us, we're assuming it's done at the end of the year. Any other questions? In order to, I have another example on cost recovery. But let's use the same example. So let's go back and let me put this up on the screen for you. Let's do 2010. Okay. So in 2010, let's just take the 2010 sale, and let's see how you would handle this if you were using cost recovery. Let's say I ask you to use the cost recovery method. What does the cost recovery method say? In 2010, you cannot recognize any profit at all until you collect $300,000. So until your cost is recovered, you don't recognize any profit. So you defer the gross profit. It's a similar model, but you defer the gross profit until you collect at least $300,000. So let's go through this. So what would you do? Well, if this was a cost recovery, let's say in 2010. Accounts receivable is $500,000, that would be debited, and your sales in 2010 are $500,000. COGS and inventory all right, so you would debit cost of goods sold and you credit inventory for $300,000. Then you collect. And you collected $210,000. It was all in 2010. How much profit would you recognize under cost recovery? Very simple principle. Nothing, right? Zero. Right? That's why this is sometimes called a zero gross profit method, because you don't use any gross profit margin at all. It's based totally on cash. So you recognize zero gross profit. How much would you have recognized had this been the installment method? 40%, $84,000. All right, so if this was, so I'm going to tell you, under cost recovery, Nothing's recognized. Under installments, $84,000. So the cost recovery method tends to be a lot more conservative. Tends to be, not always, but it tends to be. Okay. Now let's take 2011. And we're only going to track the 2010 sales. So I just want to look at the collection. So what happens in 2011? How much did you collect on 2010? 180. Right? So everyone see that you collected 180 here. Let's debit cash, 180. And you're going to credit the accounts receivable. And of course, I should go back to 2010. In 2010, let me just add one entry for you. Back in 2010, you would defer everything. You know, I said zero gross profit, but let me show it to you this way. When you close it out, you'd have to debit sales for 500. You credit COGS for 300, and then you would have deferred gross profit of 200. So, which means that you have zero gross profit in the first year. You defer the whole thing. Now, my question is, do you recognize any gross profit in the second year? Yeah, how much did you collect? Let's see, let's look at the total collections. And again, getting back, Sally, to the question before, I mean, this would be done, let's say, each quarter, each day, and once it went over the cost, you'd start recognizing profit. So in this case, your total collected is how much? You collected 210 plus 180, right? So you collected 390. And what's your cost? Right, 300. So gross profit realized now in 2011 is 90. That's it. Method's pretty simple. So what you would do is debit deferred gross profit and credit realized gross profit. For 90. And that's done in 2011. All right, let's see if you can, if you really understand this. One last question for you. How much gross profit do I recognize in 2012? You collected how much? It's highlighted in yellow. 110. How much gross profit? 110. Recognize the whole thing. So in 2012, you would collect, you have a debit to cash and a credit to accounts receivable of 110. and you would debit the deferred gross profit and credit the realized gross profit for the 110. Okay, so now you've realized 110 plus 90 is the 200 gross profit. So now it's fully recognized. And that is the cost recovery method. I have another example in the notes if you want to follow it, but I just want to make sure you had some exposure to cost recovery. And that's it. Very similar to installments, but different in the timing of the revenue recognition.
Basically, you don't recognize the gross profit until after you cut surpassing cost of goods sold.
Yeah, until you collect. Once you collect 300, every dollar after that is profit. You don't prorate it by a percentage. So you just have to wait until you collect 300. Yeah, it's got to be full realization. So once you collect 301, you recognize a dollar. And then every dollar after that is going to be profit. Okay, so that's cost recovery. All right, the reason why I covered cost recovery is because although, in a sense, IFRS does not permit cash basis accounting, they do permit this in a little bit different form for contract accounting. Under IFRS, you have percentage of completion, and you have something known as the zero gross profit method, which is kind of similar to this. So internationally, there's no completed contract. It's more of a zero gross profit method. Okay. Any other questions? Now, the reason why you would use a cash basis and sell with the default risk is the idea that you've got repossessions. So let's take a look at how you would account for repossessions. And again, as I said, you've got the T accounts. You could follow through on that illustration as well. But on the repossessions, if you think about the high default risk, you have to realize that companies do have a backup in the sense that you've got the ability to repossess high-value merchandise. When we repossess the merchandise, it comes to us at fair value. So it's going to be appraised. Now, you could have a gain or loss. The gain or loss is going to be the difference between the fair value of the repossessed merchandise and the net asset value on the balance sheet. The net asset value, and I think I mentioned this, some companies will in fact show the deferred gross profit and the installment receivables net on the balance sheet. So here, when you look at this, I have an account. This would have to be a specific customer. I have a $200,000 installment receivable, and I have an $80,000 deferred gross profit. The net asset value is 120. If the company has to write off the receivable net of the deferred gross profit, they have to write off the net asset value because the asset is worthless now, but they are going to repossess the merchandise. And the fair value of the repossessed merchandise is going to be $100,000. That means that there is a loss of 20. $20,000 loss on the repossessed merchandise, and that has to be recognized immediately. And the entry that you would make, you have to remove the deferred gross profit and the installment sales receivable. That receivable net of the deferred gross profit is the net asset value. That's 120. You put the repossessed inventory on your books at fair value, and the difference is a loss. And that loss is recognized on the date of the repossession. So this would be the same whether this was an installment sale or a zero gross profit or a cash basis using cost recovery. Same thing. You have a net asset value and you repossess the merchandise. All right, any questions on repossessions? This is sort of a little side note, not that difficult, but something you should realize that really I think justifies using the cost recovery method and the installment method in practice. All right, and one last thing, but I want to be sure. Any questions now on installment sales, cost recovery, and or repossessions? All right, last thing that we want to look at, and I do have another example on cost recovery here. You can look at it. We're going to look at the software revenue recognition problem, and they have what are known as multiple deliverables. And let me go right to the software revenue recognition and these multiple deliverable contracts. This can also be for telecommunication companies or networks that we have. We have two possibilities. One, you've got a long-term contract where the system that you're installing is not fully functional until the contract is complete. So let's make sure we think about a system. Let's say that, once again, we're combining the registration, the transcripts, and the billing for the hospitals and the new parts of Rutgers into the Rutgers system. Got to integrate it. If the software developer tells us that the system is not going to be fully functional until all three pieces are together, then you would use a percentage of completion, right? So you would use percentage of completion here. However, if the software developer tells us that, and a lot of you have worked before, that we can roll out installation in phases. So in the first phase, we might be able to get you billing. Second phase, we might be able to get you registration jointly, or grades could be merged. Maybe the grades merger might be the first thing we want to do, because some medical students may want to take MBA classes. There are lots of schools that offer MBAs and MD degrees combined. So maybe that's where we want to go. But the point is that each element is fully functional as it's delivered. Now the question is, how do you recognize revenue on a multiple deliverable arrangement where the pieces are fully functional? We're going to use something known as a relative sales value basis. And the sales value we're going to use is something known as vendor-specific objective evidence. And I just wanted to tell you that this is one of the exceptions to fair value. If you remember back in Chapter 17, when I went through the 6 steps of implementing fair value accounting, and I said one of the things that we needed to do was to look at fair value from a market participant approach. This is an exception. This is an entity-specific value. Vendor-specific objective evidence is the price that we would charge for the same element separately. So if this software developer went to another university and simply wanted to build a registration system, how much would you charge just for the registration system? That's vendor-specific objective evidence. How much would you charge only for the billing system? How much would you charge solely for the transcripts? These would be vendor-specific objective evidence. If we don't have that, we would then look at what we expect management to charge. Now, this is not a market-based measure. This is an entity-specific measure, which, as I tell you, sort of violates or is an exception to the market participant view in what we covered in ASC 820 in the fair value measurement section. Now, here's the way it would work. On the bottom of page 8, let's assume that we have 3 products that are going to be bundled. The total contract price is $1,000. And we have 3 products, 1, 2, and 3. And their standalone values the standalone fair values are 400, 305. So if each one was installed separately, I would be able to have 400 for P1. Then if I installed at a different school, P2, 305. I have a fixed contract price of $1,000. What I'm going to need to do is to allocate that contract price to each component and recognize revenue as it is delivered. Because only if, by the way, only if it's fully functional on delivery. So if we look at the table, it tells us that using relative fair market value, and this should not be totally foreign to you because I believe in Intro to Accounting, don't you look at situations where you buy a factory and there's land, building, and then equipment, and you take the total price for that factory and you allocate it? Same idea. You do it with relative fair market value. So I find out that P1, which could be the billing system, is 33% of the total contract. I find out that the grading system, or the registration system, is 25%, and the other part is about 42%. P2 is delivered, and it is fully functional. If that is fully functional, I would multiply 25% times the 1,000 to get 250. I'd recognize that as revenue. When I deliver P1, I recognize 333, and whenever I deliver P3, I recognize 417. So let's say that the university pays the contractor up front, debits cash for 1,000. The contractor, when they receive the 1,000, debits cash. They credit software revenue for the delivered component and unearned revenue for the undelivered elements. The undelivered elements at 750 are now considered to be performance obligations. Under the new revenue recognition standards, these are now considered performance obligations. When they first collect, I did this in one entry, but if they first collected and didn't deliver anything, it would have been a credit to unearned or performance liability, and then you would amortize it like you would any unearned revenue. Okay. So multiple deliverable arrangements are recognized in phases by using a relative fair market value basis, but you can only recognize it if it is delivered and it is fully functional. Anything that's not fully functional would not be recognized. Okay. All right, and finally, just want to show you some, footnotes or disclosures. And in this case, we have a company, again, a hypothetical. I took an actual software company that uses installment sales. And essentially what I wanted to show you here is that this company has installment sales buried with trade receivables. And this again should be on page 10. And their trade receivables, or I should say their installment receivables, are both current and non-current, which tells me that the installments are not a major part of their operations, so that the installment sales receivables that are considered to be current are based on being collected in 1 year from the balance sheet date. The installment sales receivables that are non-current will be collected beyond 1 year. Notice they combine both the trade and the installment receivables. Down on the liability side of this, you've got unearned revenues, both current and long-term. So again, the deferred gross profit is buried in here, and that would lead me to believe that this is in fact not part of their normal operations. And then when you look down at the footnote, of course, they give you information about how they recognize revenue. They have revenue derived from the sale of software licenses and other related services, maintenance and support. And they actually they talk about these multiple deliverables when delivery has occurred. They also talk about this vendor-specific objective evidence, which we just covered as well. What I really wanted to show you is here, when we look at the percentage of completion method, they use that, and they're actually using a ratio of labor hours, and that is another input measure. We use cost. They're using labor hours as you would study in managerial accounting. And then finally, installment sales receivable are not a significant part of this company's business. It's about maybe 11% in 2013. So probably that's why not all of those receivables are current and not all of that deferred revenue is current. Again, if it's part of your normal operations, normal operating cycle, the installment receivable would always be a current asset, and the deferred gross profit, unearned revenue, would always be current. All right, so that's all I want to say here. Now, before we go anywhere else, any questions on software revenue recognition? Again, it's a relative fair value basis. And again, the new standard, I'm giving you an update here, so once again, there is a video. What I did want to show you something here, though. If you look at, I have some examples, and what I did was I've taken this, and I just wanted to tell you that in your practice, if you're not going into public, if you work in private, these are really good resources. All of the firms, Big Four, McGladrey, all the public accounting firms will, let me move this out of the way. Why is this coming up? I don't know. All of them will have these type of bulletins. PwC has data line. KPMG has something called defining issues. And what I like about them, it takes the new standards or proposed standards, it breaks them down into relatively simple language, and it gives you really a lot of examples. So for me to present this to you, rather than reading the entire exposure draft, which could be like 500 pages, which, number one, may never actually be issued, but at the same time, to give you some good examples, I decided to add this here. So if you ever are out in the field and this is the way things come to pass, I mean, if you look at this, really good example. They show you, for example, on a sale with the right to return, you now would not book the sale. We went through this already, but just to give you a flavor for the new standard, we would now, currently, we would debit accounts receivable or cash, credit sales for the full $200,000, correct? And then you would have a sales returns and allowance. It's not the way we're going to do things anymore. We're now going to say that if you have a liability to refund on a sales return, that's got to reduce sales. So rather than grossing up sales and having a contra account, we set up the performance liability. We also actually adjust the cost of goods sold for the expected asset that's going to be returned. So if you read through these, I mean, if you need them on your job, if it comes up where this becomes the actual standard, or when the actual standard is released, get your hands on your firm, documents that have these very, very neat and simple ways of presenting the new standards. Okay, now let's get to some questions, and there are lots of examples. Oh, the warranty example is here too, all right? That's a good one, where you don't use an estimated liability for a warranty. You basically just reduce the sale. Again, the performance obligation is the contract liability. Okay, so let's go through some of these questions. What's that? No. All right, so let's take some of these questions. Some of these are definitional, some of them I just want your opinion. So let's take the first one. Under the installment sales method, what I want to know is if companies defer revenue and profit until cash is collected. Okay. Now some of these are tricky, so I'm not grading these. They will go into the system somehow. I'll figure out. I can always check your... Let's see what we got. Okay. False. False is actually the correct answer. What made this? What was wrong with the statement? Was that revenue? Right. Yeah. When you're using an installment method, and by the way, 3 is the same question for cost recovery. Right? It's the same question on the cost recovery. I just decided to ask you the first one. Same thing. You don't defer revenue. You don't defer cost of goods sold. You don't defer operating expenses. You only defer the profit. You recognize revenue, expenses, cost of goods sold, and cash collections in exactly the same way you do for regular sales. Okay? All right. Nope, you just defer the gross profit. Yeah, just the income of the profit. Right.
But cost recovery is the opposite.
Cost recovery is the same thing. You basically record everything in the same way and recognize profit only when cash payments exceed the cost of the merchandise. Right? So what makes them false, as you said, was that you don't defer. What makes these two questions false is that you don't defer the revenue. The fact that we're saying you defer revenue is what's making that incorrect. All right, so any questions on those? Yep. That's closing. It's a closing entry.
Yeah, but it's kind of like the sales were never there.
Yeah, it's the same thing when you're closing out the income summary too. You would still report the revenues. The revenues in the sales are still recorded in the same way you would always record them. But the closing entry is when you collapse them into deferred gross profit. So you're not really eliminating them. It's just a way of closing them out. It's just a way to close them relative to versus the income summary account. So instead of closing those to income summary, you close them into the deferred gross profit. At the end of the period or the end of the reporting period. Yep. And you're going to do that only when the period is at the end of the reporting period. But you recognize sales, cost of goods sold, the entries are recognized in the regular way. You would always recognize them. Because if revenue was deferred, then when you collected it, what would you have to do? You'd have to debit cash, credit, revenue, debit cost of goods sold. So we've pretty much collapsed it into that deferred gross profit account. So we didn't defer any recognition there. We just, It's if you use installments, just to give you one more justification, if you use installments for tax purposes, the amount, although it's not taxable, they still recognize the sale. So let's say I sell, I think I mentioned this to you, I can use an installment. If I sell my home to a family member and that family member gives me a personal mortgage, and let's say I sell my house at a gain of $200,000 and that gain is a 40% margin over what I paid for the house, IRS is not going to tax me at that point. They still recognize the sale took place. They didn't defer the sale. And they know the basis, they know the cost. What they defer is the profit. And they wait until I collect. As I collect the mortgage, the interest is taxable separately, and then 40% of each mortgage payment, principal payment, is taxable. So that's the equivalent of what we're doing here. We don't de-recognize the sale. It's still recognized. We still recognize the COGS. We still reduce the inventory, right? We still have the receivable. So if we were going to unwind that, it would be, we'd have a lot more debits and credits to worry about. But it's a very good question. I mean, it's an insightful question. It's not that it's, just that we have revenue and expenses. So the whole idea of installments is to be sure you understand that everything's recognized the same way. except at the end when we make our closing, we just adjust the gross profit. We defer it. All right, one last question for you. Number 4, manufacturer of a large equipment sells on an installment basis to customers with questionable credit rating. Which one of the following methods of revenue is least likely to overstate? Least likely to overstate. Or what's the most conservative approach? Point of sale, completion of production before delivery, at delivery, installment sales, or cost recovery. What is the most conservative? So most conservative, least likely to overstate, or more likely to understate income. And that one is, all right, so that's correct. Cost recovery. By the way, the first method, during the production process, that percentage of completion, I guess. Then at delivery is not going to do that. Installment sales have the most income. Cost recovery obviously is the most conservative because you got to wait till you recover your costs. Okay, great. All right, so that is it for revenue recognition. Again, for the exam, this is not on, but it will be on the next and, of course, the last. Okay, so now, finally getting into the last 2 topics. I'm going to tell you that going forward, taxes and pensions, our last 2 topics, are probably the most important in the course, and we have enough time to cover these. Once again, I will go over cash flow implications of deferred taxes of pensions. That's something I wanted to do in a capstone session or 2 at the end, but we're not going to be able to get there. So what I want to do in Module 1 is to just give you the conceptual foundation or the framework for accounting for these taxes. We'll look at temporary book tax differences, give you an idea of what we mean by deferred tax assets and liabilities, and we'll look at an income statement approach, but also make sure you understand that there's something called a balance sheet approach as well, because you can, for example, I like the income statement approach because it's much easier to teach. If I told you that you paid more tax today because you couldn't take a tax deduction, that I think you can understand that, right? You're going to pay tax if you can't take a tax deduction. But if I told you that you're going to pay more tax today because you have a higher carrying value of an asset for tax purposes, does that really kind of sink in? No. But that's the way we're supposed to think about deferred taxes. In other words, I'll give you a perfect example. You can't deduct the bad debt expense. You can't deduct bad debt expense for taxes until the account is actually uncollectible. So would your receivables be higher for tax purposes or lower? Higher because you don't have a bad debt against it. So we look at the balance sheet approach as well. But for now, I want to start with the income statement model. And on the income statement model, here's the way it works. We're going to say that on our financial statements, let's take the income statement because the traditional approach is the income statement. Based on GAAP income before tax. Tax expense is based on GAAP income before tax, and the traditional income statement model is for matching. So we try to match tax expense with GAAP income before tax. On your tax returns, you have taxable income, and your tax payable is based on that taxable income. Now, here's your dilemma. The accounting methods you use for GAAP purposes are not the same as what you use to prepare your tax return. And there's a reason for it. Different objectives. What's the objective of accounting on your financial statements? Provide information for what purpose? Decision making, right? Investments, helping financial analysts, investment analysts make rational economic decisions. What is your objective in accounting for taxes or tax code? What's the objective of the tax code? Well, raise revenue is one, right? What else? What are other objectives? How do we use the tax code in the United States? How do we use taxation in the United States? No other reason, just to raise revenue. Yeah, I mean, there are social objectives, right? So we need to collect taxes to meet certain social objectives. We also give tax benefits to meet social objectives as well. If areas of New York City are becoming depressed or run down, they might give you tax benefits to open up businesses there. Look at New York State. I still can't believe this, that if you operate in New York State now, you don't pay tax for 10 years if you open a new business in New York State. I don't know if that applies to accounting practices, but that wouldn't be a bad idea. All you guys come on over and, I don't know if you have to be a resident, but that is definitely an objective to stimulate business and jobs. It's an economic objective and a social objective in New York State. So there are different objectives for tax than there are for financial reporting, and therefore you should expect, without too much argument, and you should agree, that the accounting method should be different. The dilemma for the accountant, however, is that debits don't equal credits anymore, because the debit to tax expense does not equal the credit to tax payable. And the difference is going to be the deferred tax. Could be a deferred tax asset or liability. This is very counterintuitive. If you pay more tax than the GAAP expense, you got an asset. It's like a prepaid. If you pay less tax, you have almost borrowed money from the government, got a liability. Let me show you how this works. Have an example. I'm going to go through a couple of simple examples today, because the first thing to do before we get bogged down in any kind of set of rules or standards is to understand the basic concepts, and I think the basic concepts are best explained through an income statement illustration. So, and by the way, here's a summary of the balance sheet approach, which we will get throughout. Now, using this income statement approach, take the example on page 3. It tells you that we have a company whose taxable income is $300,000, but its book income is $520,000. And how does that happen? And the tax rate's 40%. It happens because the company is using accelerated or MACRS for tax, let me try to get some different colors in here so you can see it. I don't think I know what I'm telling. Okay, so for GAAP purposes, I'm using straight line. All I need, by the way, is a difference of 220,000. So let's make this 600. So I'm able to deduct $600,000 every year for GAAP purposes. For tax purposes, however, I use MACRS, accelerated. So in the first year, let's assume that I deduct 820. 820. So now I've got a book tax difference. It's temporary. Of 220. Here's the logic. And by the way, book tax differences originate in countries like the United States, Britain, Australia, Canada. Mostly countries following the US, UK kind of model will have deferred taxes. In countries in continental Europe and Japan, most of the tax law is required on the financial statements. So you get very few deferred taxes. So in Germany, you get very few deferred taxes. In Japan, you get very few book tax differences. In the United States, it's wide open. There's hundreds of book tax differences. You got deferred taxes, which become very significant. If we didn't have book tax differences, we'd be done. I mean, half the semester would be gone, basically, playing around with this, because we still have to worry about the income tax effects throughout the courses. We have to worry about the cash flow effects. So what will happen here is that in the early years of the asset's life, so right here, let's say in year one, you get a tax advantage. Then you get, at some point, you're going to get a reversal. These are not permanent differences. There are permanent differences which we'll get to. What are permanent differences? Tax-free interest. It's never going to be taxable. Tax-free interest never will be taxable. Then you get more complications because then you get some tax-free on a state level but not on the federal level. So it gets a little bit more complicated, but you do have permanent differences. This is a temporary difference. This is going to reverse. And when that happens, you now get into a tax disadvantage. You pay less tax today, you pay more tax later. This means, in our example, that we have a deferred liability. Now again, as I said, you have to think of this, it's counterintuitive. You pay less tax, you have a liability. Why? You have to pay it later when you lose the tax benefit. When you pay more tax, you got an asset. Well, why? Well, because I get a tax deduction later. I'm prepaying the tax. So in my example, and by the way, this will not always work out, but just to make this very simple, in my illustration, I'm going to take 40% of book income, that tax expense of 208. That's the expense that matches with my GAAP income. And I don't care, even though I know I'm only going to owe the government 120 this year. Now the government doesn't, they do look at, if anyone worked in tax on an internship, the government does look at your balance sheet, income statement on a GAAP basis. But right now, they don't care. You're good to go if you pay the 120. The difference, in this case, you paid less tax today, you're going to owe them more in the future. You have an $88,000 deferred tax liability. It's a DTL, deferred liability. Now, very difficult to teach this, especially when you're teaching this. You guys have lots of accounting. Some people, when I do this in corporations, people have no accounting. They say, wait a minute, you just told us on the intro side of this that that's an accrual, isn't it? Well, it is. It's really an accrued tax. Because what you're really doing is debiting tax expense and crediting DTL for $88,000. You're actually accruing more tax. We call it a deferred tax because the payment is pushed back. So the journal entry that you would make in this case would be to debit tax expense for 208. That is called the tax provision. you're going to credit the increase or the change in tax payable. That's known as the current provision. And then finally, you credit the deferred liability known as the deferred provision. In reality, this is the only way you should build a tax provision. You really should not multiply GAAP income by a tax rate. In other words, when you look at the tax reporting model, the first thing you should do is either get the tax return from the client, or within your firm, they do the tax return. So that's 120. Then you do an analysis of book tax differences, and you know what? There could be 5, 10, 100 book tax differences. You have to take a look at the temporary book tax differences and the sum of, and let me just show you this right here. This is a critical piece. Your income tax expense in the yellow highlighted area is equal to the change in tax payable plus or minus the change in the deferred tax. You really can't, and you notice up here on the third step, I don't say multiply GAAP income by a tax rate. It does not always work. There are cases where it works. It only works when you don't have a permanent difference. Once this gets really thick and complicated, if you use a tax rate against book income, you're going to get the wrong answer. So the way you build the provision is to take the current plus the deferred, and that becomes your tax expense. Tax expense is synonymous with tax provision. The change in the tax payable is the current provision, and the change in the deferred tax account is the deferred provision. So again, the justification, different objectives, GAAP and tax, different reporting methods lead to different expenses and liabilities. The difference is the deferred tax. Now, I'm going to tell you, just based on experience, that the new accounting standard, the more recent, or the standard we use now, is balance sheet focused. And as I said, I gave you information, you can read that through. We'll definitely cover it. But the balance sheet focus was done because most financial analysts said, and I used to hear this for years, deferred tax is a plug. It doesn't mean anything, right? You're just balancing the balance sheet because technically you're never going to pay this. I mean, what's going to happen is that you're going to buy more assets, you're going to expand, right? So what will happen is that you're going to buy more assets, you're going to expand, these curves get kicked out, the reversal point keeps getting further and further away, and from a discounted cash flow perspective, today's liability is what? Zero. It's by the time you pay it, it's going to be zero. So most analysts pretty much don't even look at the deferred tax and tax asset and liability, or they didn't. Now our focus is on properly measuring the deferred asset or liability. So rather than being sort of the plug, the way I'm looking at this is the way it should be done. You first get the payable, then you focus on the proper measurement, and then the expense kind of gets forced. And what this is going to do is cause a lot of volatility in income. Anytime you take an income statement perspective and flop it and make it less important than a balance sheet, once you emphasize a balance sheet, then the income starts to get volatile. And you'll see this throughout our coverage of deferred taxes. Now, just a couple of definitions, and I'm going to go into another example for you. Make sure when you look at and you read this through that you understand deferred liabilities mean you pay less tax today. You're going to pay more tax in the future when you have what are known as future taxable amounts. So that this 220 is a future taxable amount. It becomes taxable when you have an unfavorable book tax difference. Deferred tax asset, you pay more now. Not because you want to, because you have to. You can't deduct the bad debt expense until the account is uncollectible. You cannot deduct warranty expenses unless you fix the product. So you have more expenses on your books less for tax, you pay more tax. Now, the only problem we're going to see, and I have this, by the way, I've got lots of I'm not going to read this, off a slide or off a screen. You should really read these through. I mean, I think I've got this to in a way that it should be easy to understand. I talk about each type of transaction. So let's take this one for example. You can't deduct warranties for tax until you fix the product. You can deduct a warranty for your book in the year of the sale. More expenses on your books means you have less tax expense than tax payable, or you pay more tax than the expense on your books, giving you a deferred tax asset. I'm also going to tell you that the big problem with deferred tax assets are that in order to have a future tax deduction to be valuable, what do you need? Taxable income. So here's a problem. The deferred tax asset is extremely controversial because you need to have future tax deductions matched with future taxable income. If you don't have future taxable income, those deductions are worthless, right? I mean, what if you built up, someone like my age, I'm saying, I'll retire and I don't know who knows when, but let me start investing in very, very, good future tax deductions. Hey, if I retire, right, I'm not going to have income, and what am I going to use the tax deductions for? It's better for me to take those deductions now than to take them later, right? But if you have a tax deduction, you need future income to make that valuable. Because of the uncertainty of future income, believe it or not, we set up a valuation allowance against deferred tax assets just like a bad debt expense. And we're going to cover that as well. So I would recommend reading all this through, making sure you understand why something is a tax asset, why something is a deferred liability. Now, I'm going to give you another example. This gets, as I said, this is not easy material, and it's going to take a lot of reading on your part, and on my part, I'm going to go through as many examples as I can. Let me give you another one. Take a look at Target. There's an actual set of financial statements from Target. Let's go down to the liabilities. They don't have a deferred tax asset valuation allowance here. Look at the DTLs. Okay, so this is on page 8, I think, right? Look at the DTLs. They're telling you they have a deferred tax liability because of property, plant, and equipment. What does that mean? Probably they're using, and again, I'm just giving you an exercise not only for the course, but in practice. If you're not working in tax, if you're analyzing statements, if you're looking at your client statements, you got to be able to reason this out. So I'm not a tax accountant. How could I have a deferred liability if I'm dealing with plant assets? It's got to be depreciation. It's got to be that I'm taking accelerated deductions now. I'm going to owe more in the future. How do I get a deferred liability for deferred credit card income? Now let's reason that out. What does that mean? A deferred liability means I'm paying less tax today. So where am I deferring the revenue? On my books or on my tax return? Yeah, exactly. I'm deferring revenue on my tax return. So probably what's happening is as the credit card revenue is coming in, maybe prepaid, they might have some prepaid credit card or something, this is being recognized in full on my income statement for GAAP. For tax, it's probably waiting until the transactions are used up, maybe going forward. Okay. So you're deferring it for tax. Take a look at the tax assets. All of those are expenses. Bad debt expense, self-insurance, accrued deferred compensation. Why is that a tax asset? Well, before you answer the question, it means you're paying more tax today. It means you probably have lower tax deductions. So how do you explain the allowance for bad debts? I take bad debt expense on my books, can't take it for tax until what happens? The account is uncollectible, right? Pay more tax today. Deferred comp. Studying for the exam for Thursday. What type of option plans do you have? Qualified and non-qualified. On a non-qualified plan, I could take a tax deduction, but only when it's exercised. When do I expense this for GAAP purposes? Over the vesting period. So I have an accelerated expense on my books, but for tax purposes, I can't take it until you exercise it. So I have a future tax deduction, and that's what makes it a tax asset. Another example, accrued vacation pay. I'm deducting, now, for example, I don't know if it happens here, but some of the administrators do. You may have heard some people would have vacation pay that carries over. If you accrue vacation pay in 2014, I expense it in 2014. When could I deduct it? When you take the vacation. You might take that 5 years from now when you quit the firm, but it's not a tax deduction until you actually take the vacation. So I expense it on my books before I take the tax deduction. And therefore, I pay more tax today. And that's a deferred tax asset. So I would ask you to read these through. I'm going to give you examples, and you'll see plenty of it. And this is something I think you really can't live with illustrations. You really need to understand, because once you get a transaction that looks a little different, you're going to implode. I mean, if you just look at specific examples and don't understand why something is a tax asset or why it's a tax liability, all bets are off if you see a transaction that's not familiar. So just make sure you get the general concepts, and that's what I'm trying to do today. Let me give you another example, which I consider a personal illustration. I want to prove to you that you, in fact, have deferred taxes, and you do that through pension plans. So let's take a look at a person who earns $100,000 in 2012 and decides to open up a tax-deductible pension plan. And you're in a 35% tax bracket. When you file your tax return, or when you filed in 2012, you had wages of $100, you deducted the IRA, taxable income is $95, and at 35% tax rate, you owe the government $33,250. Now, by opening the IRA, you basically saved $1,750 this year. So when we look at this from the correct approach is first, get the tax provision. Second, get the deferred tax. And third, you really build the tax provision by the sum of these two. So in this case, my taxable income is $95. At 35%, I owe the government $33,250. Now, when the IRA, the $5,000, when it is removed from the account, it becomes taxable. Two things you have to know. We'll talk about tax rate changes later, but unless you hear anything about a tax rate change, you've got to assume that it is constant. And here's the second and probably the most difficult for you to accept. We do not use discounted cash flow. We ignore the time value of money. So we assume that the $1,750 you saved in 2012 will be exactly as valuable as the $1,750 when you pay it back in 2016 and 2017. Not true. We do not discount deferred taxes. And there's a reason for it. I guess the easiest way for me to explain this to you is that the standard setters did not want to open up the ability of managers to discount deferred liabilities, because if you did, then most deferred liabilities related to long-term pensions, related to deferred taxes on equipment or buildings, when you discounted back, those liabilities would go close to what? Zero. So to avoid having no liability, they decided not to discount. Now, it's probably wrong economically, and there is one exception that we'll look at where you do discount deferred taxes. So in this case, it is a temporary book tax difference. The temporary book tax difference is $5,000. And the tax rate is 35%. So the deferred tax is $1,750. So that means that your tax expense is the sum of the current provision plus the deferred provision. The current provision is your change in the tax payable, $33,250. The deferred provision is $1,750, and the tax expense would be $35,000. It's the sum of the two. Now, does that match? Yes, it does, because if you look here, your reported income, your GAAP income is $100,000. So this matches with GAAP income. Now, why is your GAAP income $100,000? Well, that's your reported income. If someone asked you, what was your gross income? What was your income for 2012? It's $100,000. It's not $95,000. That $5,000 pension deposit is not an expense to you. It just took $5,000 of your own money and put it in a different asset. It didn't change your income. So when you look at this now, of course, it works this way that this will be 35% of your book income, but nonetheless, the right way to do this is, or the correct way to do this, is to bill the current plus the deferred. I will show you when this won't work. I'll definitely point out cases where you just can't take a tax rate multiplied by the book income. Now, of course, one of the things you have to know is the entry. So this is the year of origination. I'll talk to you about this in a second. You've got a debit to tax expense for the provision for taxes. You credit tax payable, and of course the deferred tax is the deferred provision credited for $1,750. The effective tax rate, sometimes known as the actual tax rate, it's effective or actual, is the ratio of GAAP tax expense divided by pre-tax GAAP income. Now, in this case, the effective tax rate is equal to the federal rate. It's not always the case. And I can tell you that whenever the effective tax rate and the federal rate are the same, you could always multiply book income by the federal rate. The problem is that most people, when they take these courses in, let's say, management or finance, they see a tax rate and they multiply it. They think it's the federal rate. It's not. It's the effective rate. So you have to remember that the effective rate is still 35%. Now, when you withdraw, assuming that the tax rate doesn't change, and again, we do not use the time value of money. Let's say you take half in 2016, half in 2017. So you're going to be taking, $2,500 per year. And at 35%, that's $875. Notice what happens. You now pay back the tax. And now the book tax difference reverses. So now you have a reversal. And on reversal, you pay back the tax. You debit the deferred tax liability, and you credit cash. So in this case, actual reversal takes place. There is an actual payback of that liability. And when you look at the T accounts, I think something that is extremely important is that under the accounting standards that we use, we will always, and in the textbook world, we always zero out the deferred liability. So first of all, let's talk about originating and reversing differences. An originating difference is the first direction that the account takes. Liabilities originate on the credit side, assets originate on the debit side. On originating differences, in this case, we only have one pension deposit. If you had more than one pension deposit, they would be building up. So in 2012, the liability originates. That's what we see here. Then the reversal. In 2016, when you withdraw, and I'll highlight that in green, when you withdraw $2,500, you will pay back $875, which leaves you with a liability of $875. And then the next reversal is when you take out the remaining $2,500. That reverses out, and that would give you a payment of $875. Once you pay that back, then the account goes to zero. So that in a textbook world, we'll always have a zero balance at the end of the life of any transaction. At the end of the life of any transaction, we're going to have a complete reversal and you fully pay back that liability. Now, again, this is a case, simple case, but it does at least reflect, or it gives you some, I think, good measure of the deferred taxes. Okay. All right. Now, any questions on the deferred tax liability? Any questions on the deferred tax liability? Any questions on this example? Any questions on the depreciation? Questions on the difference between deferred tax assets, deferred tax liabilities? Just want to make sure before we do anything else. Okay. All right. Now, just want to show you a little bit on another illustration. Here's another case, which is a basic example, and this should be user-friendly. It will take you through some depreciation. And let me just spend a couple of minutes on this, and then we're going to stop, and then we're going to talk about the exam. But let's look at a depreciation case. And let's say you have a plant asset with a cost of $300, no residual. Company is subject to a 40% tax rate, and the asset is going to be depreciated using straight line for GAAP on a 6-year, and I want you to see this assumption carefully. It's a 6-year asset for GAAP, and the straight line depreciation, of course, would be $50,000 per year. For MACRS, we're using 5-year property. And here's the table. Now, I'm sure you covered this, right, in your first tax course, a little bit of MACRS or not? You did. So you know that how these percentages work. What are these percentages? Did you just get the percentages, or do you know what they mean? Yeah, it's double declining with half a year in the first year, and then you switch to what? Straight line. Yeah, you switch to straight line right here. Now, you switch to the optimal point. I think I did some of this with you in intro, I believe. I think not intro, in intermediate 1 as well. All right, so all you need to do in this particular example is to take the percentages as given. So if you take the percentages as given and you multiply that out against the cost of the asset, and you would get the depreciation. So that each year those depreciation numbers would be very easy to get. Just take the percentages, multiply it by the cost. Now, here's what I want to leave you with, and we'll pick this up. Using an income statement perspective. Now remember, we're not doing the balance sheet perspective yet, but using an income statement perspective, you would look year by year, and here's the point I want to make. I want you to be sure that you understand the difference between a deferred provision, an income statement effect, and a deferred tax liability, which is a cumulative balance sheet effect. So let me just do 2 years and then we'll stop. In the first year, MACRS is 60, straight line is 50. You now have a tax advantage of $10,000. That tax advantage at 40% would save you $4,000, but because we know there is reversal, this is a future taxable amount. Future taxable amount is $10,000. And that would give rise to a deferred liability. So right now on your balance sheet, you've got a liability of 4. In the second year, MACRS is 96,000. Straight line is 50. The book tax difference is 46. This again is a future taxable amount, but for my provision for deferred taxes, which is right here, that's the deferred tax provision, temporary book tax difference times the tax rate, that would mean I would get a deferred tax provision of 18.4, but notice on the balance sheet it's 22.4. So what I want you to be cognizant of, in fact, let me show you the T account now. We're going to go over this again, but keep in mind that if you look at the T account, these balances are cumulative until they start to reverse. So one of the things I want to leave you with is that you have to be very clear to understand the difference between a deferred tax provision and a deferred tax liability. The provision is the change in the deferred liability. So the $4,000 in year 1 is the deferred tax provision for that year, and 18.4 is the deferred tax provision for year 2. Okay. All right, so we're going to